Welcome back, everyone, to another deep dive with us. Today, we're going to be taking a look at something that's really been shaking up the oil and gas world. That's the huge amount of mergers and acquisitions that have been happening lately, specifically in the U.S. oil and gas production side of things. And we've got a great report to help us break it all down. It's called Strategic Mergers and Acquisitions, the ongoing trend of industry consolidation in upstream oil and gas.
Yeah, it's a really in-depth look, and it's got some pretty eye-opening numbers about just how big this trend has become, especially in 2024.
That's right. 2024 was a record year in a lot of ways. The report says that there were $105 billion in M&A deals. That's billion with a B.
Wow.
That makes it the third highest year ever. So this is not just some small thing happening. This is pointing to some major changes in the industry.
Absolutely. I mean, we're not just talking about a few companies here and there deciding to join forces. This level of activity really signals a whole reshaping of the industry. It's going to be really interesting to see who the major players end up being as things shake out.
So let's dig into the why behind all of this. Why are we seeing this merger mania? The report lays out four main reasons. The first one is efficiency and scale. Basically, the idea is that bigger companies have a real leg up in a market that's kind of all over the place like this one.
Right. When the price of oil and gas is going up and down all the time, larger companies can kind of spread their costs out over a much bigger operation that gives them more stability and flexibility. Smaller companies, they really feel those price swings a lot more.
It makes me think of, those bulk discounts you get at Costco or something. If you buy more at once, it can actually save you money in the long run. I guess it's kind of similar in this industry.
Yeah, exactly. And it's not just about basic costs either. Think about things like needing to do geological surveys on a bunch of different drilling sites. A big company might just need to hire one geologist to handle all of them, but smaller companies, they might need to hire separate geologists for each site. That really adds up.
Yeah, it makes a lot of sense. Okay, so what about the second driver? The report talks about something called limited drilling inventory.
What does that even mean?
Well, imagine the best places to drill for oil and gas are like really desirable pieces of property, like beachfront property or something. Over time, most of those prime spots have already been snapped up. So if a company wants to expand and get access to new reserves, they might have to buy out a company that already has drilling rights in those areas.
So it's like they're buying companies to get their hands on the resources they control.
Yeah, that's a good way to put it.
And that ties into the third driver I see, valuation disparities.
Right.
What's that all about?
Sometimes you have these smaller companies that the market just doesn't fully appreciate. Maybe they haven't developed their oil and gas reserves as much, or maybe investors just aren't seeing their full potential, so they end up being undervalued. And that makes them really attractive targets for bigger companies who are looking to expand without spending a fortune.
It sounds like bargain hunting, but for oil and gas companies.
Exactly.
They're looking for those hidden gems. Okay, so the fourth driver then, capital constraints. This sounds like it's about money.
It is. Basically, it's getting harder and harder for smaller companies to get the funding they need to operate and grow, especially with interest rates going up like they have been. So that makes them more vulnerable to being bought out by bigger companies that have a lot more cash on hand.
So it really does sound like all these factors are kind of pushing the industry in one direction towards consolidation. It makes you wonder what happens to all the smaller companies in this environment. Do they just get swallowed up by the giants?
That's the big question, isn't it? And it's one we'll definitely dig into more. But it's not all doom and gloom for the little guys. There are definitely challenges. But some interesting opportunities have come up too. It's not as simple as it might seem at first glance.
Okay, so we've talked about how the bigger companies have this advantage in the current market. But what does that actually mean for the smaller operations and contractors? The ones that are trying to compete in this landscape where everyone seems to be getting bigger and bigger.
It's tough, that's for sure. Now imagine trying to go after the same contracts or resources when you're up against these huge companies.
Site.
It's kind of like David and Goliath, except David brought a slingshot to a Tang fight or something. Smaller companies just often can't match the resources and the technology of the bigger players.
So what do they do? How do they adapt? Does the report talk about what some of these smaller companies are doing?
Yeah, it does. It actually says that for some companies, this whole consolidation trend might be the perfect time to just cash out.
Oh, interesting.
Yeah, they might decide to sell their assets to a bigger company and then take that money and invest it somewhere else, maybe in a different industry even.
So it's like knowing when to fold your cards in poker.
Exactly. Sometimes the best move is to walk away with what you've got.
So that's one option. What about the companies that want to stay in the game? Are they just doomed?
Not necessarily. For some mid-sized companies, this could be an opportunity to grow.
Really?
Yeah, they might be able to buy up some of the smaller players themselves,
Okay.
and that way they can gradually get bigger and become more competitive.
So it's not just the giants swallowing up the little guys. Some of the smaller fish are joining forces too.
That's a good way to think about it. And it's important to remember that it's not just traditional oil and gas companies involved here. Private equity firms are playing a bigger and bigger role. They've got a lot of money to invest, and they're always looking for profitable opportunities. So they might buy up a bunch of assets and then restructure them and sell them for a profit a few years down the line.
So it's like a whole other layer of complexity on top of everything else.
Yeah, exactly.
So we've been talking about this consolidation in general terms, but are there any specific regions where this is happening more than others?
The report talks about the Permian Basin. That's in Texas and New Mexico. It's always been a hot spot for oil and gas production. And it looks like it's a hot spot for M&A activity, too.
Makes sense. But there's another trend that caught my eye in the report.
What's that?
Gas-focused acquisitions. The report says that the total value of those deals actually quadrupled in 2024.
Wow.
Yeah, it hit over $20 billion.
That's the first time it's been that high since 2016.
Why do you think we're seeing this sudden interest in natural gas?
Well, a couple of reasons, I think. First, the global demand for liquefied natural gas has been going way up.
LNG?
Yeah, LNG. It's seen as a cleaner alternative to coal for generating electricity. And a lot of countries are trying to reduce their carbon emissions.
Right.
So that's a big factor.
So it's not just a global thing then?
No, it's happening here in the U.S. too. Natural gas is playing a bigger role in our energy mix.
For sure.
We use it to generate electricity, to heat our homes, even as a raw material for different industrial processes.
So with all this going on, all this M&A activity and all these different factors at play, what do you think the future holds for the oil and gas industry? What does the report say?
Well, it says we might see the pace of deals slow down a little in 2025, just because there might not be as many attractive companies left to buy.
Okay.
But the overall trend of consolidation, that's expected to continue.
So the frenzy might die down a bit, but the underlying forces are still there. And of course, there are always things that could throw everything off, like some big global event or a sudden change in energy demand. It just shows how complex this industry is and how interconnected it is with everything else that's going on in the world. So we've talked a lot about the business side of this, but I have to ask, what about the impact on consumers like you and me?
That's the million-dollar question, isn't it? How will all this affect energy prices and how easy it is to get the energy we need, both here in the U.S. and globally?
Yeah, it seems like these mergers and acquisitions are going to have some kind of ripple effect.
It's hard to say for sure, what the long-term impacts are going to be. I mean, in the short term, it's possible that consolidation could actually lead to lower prices.
Yeah.
When you have these bigger companies, they can often invest more in technology and make their operations more efficient.
So it could actually be good for consumers.
It's possible, at least for a while. But on the other hand, you have to think about competition.
Right.
If you have fewer companies controlling the market, they might be able to have more influence on prices.
So it's kind of a trade-off then.
Yeah, I think so. It's like you might get some benefits in the short term, but then there could be risks down the road.
And it's not just about the companies themselves, right? You have to factor in all these other things too.
Absolutely.
Government regulations, global demand for energy, what's happening with renewable energy sources.
It's all connected.
It really is. It's like trying to predict the weather. There's so many variables that it's almost impossible to say for sure what's going to happen.
Yeah, but at least this report gives us a framework for thinking about it.
For sure. It helps us understand the forces that are at play.
Exactly.
I know I've learned a lot from this deep dive, and I hope our listeners have too.
Me too.
Hmm.
I always find it fascinating to kind of peel back the layers of these complex issues.
Yeah, it's important to look beyond the headlines and try to understand how these things might affect us in our daily lives.
Absolutely.
Well, I think it's about time for us to wrap things up. But before we go, I want to leave our listeners with one final thought. We've talked about all this M&A activity and the factors driving it and the potential impact on energy prices. But what I keep coming back to is how all of this fits into the bigger picture of energy transition.
Oh, that's interesting.
We talk about natural gas being this bridge fuel to a cleaner energy future.
Right.
But at the same time, we see all these companies investing huge amounts of money in oil and gas assets. It makes you wonder how committed they really are to a sustainable future.
Yeah, that's a really good point.
Mm.
Are they just trying to make as much money as they can now? Or are they thinking about the long term?
That's the question, isn't it? And I don't know the answer, But I think it's something we all need to be thinking about. So to our listeners out there, I encourage you to keep digging into this topic. Don't just accept the headlines at face value. Think about the long-term implications of what's happening. How will this affect the choices we make about energy in the years to come? And what role will these big companies play in shaping a sustainable future?
Those are great questions.
Well, on that note, I want to thank you all for joining us on this deep dive into the world of oil and gas mergers and acquisitions. We hope you found it informative and thought-provoking. Until next time, stay curious.